Let's actually get in a market voice. Shailendra Kumar, he's director and CIO at Dunn Securities, joins us on the show. By the way, sorry, NI numbers out on the screen as well, 40%. So on cue, the top line numbers look, or the NI numbers look very impressive. Asset quality looks impressive. Bottom line numbers way higher. All in all, a very good quarter. Mr. Kumar, thanks so much for joining in. Good afternoon to you.
Yeah,
financials, by and large, I don't know if you individually have thoughts on Bajaj Finance, the big boy, but financials, by and large, seem to have reported a fairly decent set of numbers. I recollect Edelweiss doing well. I recollect the SFBs doing well. Consumer finance companies haven't faltered too much. Capital First was okay. Bajaj Finance, the big boy, doing extremely well. What are your thoughts here? And if you track Bajaj Finance individually, or if you have thoughts on this one individually, then this one too, what do you make of these numbers?
Sure, all the financials given good results. One trend which is disturbing is like for housing finance company, you have seen some kind of a comparison in the margin for housing finance company. Coming to Bajaj Finance, it's a very strong company, excellent 4-5 years of growth backing the company, excellent execution by the management. The kind of advantage of digitization that Bajaj Finance has happened, and the way they have kept the cost pretty controlled all through. So even at current level and the kind of result it has come out with, it's excellent buy even at the current level to our this thing. Like it's a great buy and hold.
The last 5 quarters, I remember, Mr. Kumar, there were some question marks about the pace at which the loan book can grow and whether it can maintain the asset quality. We don't quite know the answer on the loan book, but you would presume that the asset quality at 1.48, they've pulled it back to levels that we used to see in the first couple of quarters of FY17. FY18 was largely a 1.6, 1.7 number on the GNPAs.
Right.
It's come down to 1.48, arguably in line with what the management was guiding.
See, like both in terms of stock prices take first. So last 1.5 years, Bajaj Finance has not done much. So it has almost traded sideways, right? But that is more to do because of the valuation was very high a year and a half back. There's a lot of optimism about the company. So valuation is got stressed. So kind of a time correction was happening in the price. And if you look at the business per se, the kind of NPA expectation along with the competition getting heated. So Capital First came very aggressively, trying to, ride on a wave similar to what Bajaj Finance was doing. But see, the management of Bajaj Finance, even in the past, the kind of execution capability they have shown, and the cost control and the growth getting managed. So this result also makes sure it's a very clear-cut outcome of the management pedigree, I would say. Like so, even in a deteriorating environment, they are producing such kind of a phenomenal result. So it gives you a lot of comfort to hold it for a real long-term investment purpose.
Well, a question on the entire sector then right now, with the way Bajaj Finance is, playing out in terms of performance, that is not the case when it comes to a lot of the other relatively smaller players. You just suggested there were concerns with respect to some housing finance companies. Then what is the best way to play the NBFCs right now? Would it be microfinance in comparison? If not housing finance, then what else can there be?
Okay, so for investment purpose, the capital market entity like Edelweiss could be a good idea to own, because the way the business is growing and management at every level of growth is able to manage the business, keep the cost in control. So the second, third line of the management also is coming out pretty well.
Right.
So those are areas. Some of the previous microfinance company who has become bank, so one I can name Equitas Holding, is something we are liking a lot, even at the current levels.
All right. So staying with the financials, but shifting focus to banks then. Naturally, the preference, I'm assuming in this case, that it will be towards the private sector banks. How is it looking and what would the preferences be?
Okay, so private sector bank primarily because, the kind of market share gain for all these private sector bank is happening on a every quarter-to-quarter basis.
Right.
And PSU is consistently losing the, the market share. But if I look from long-term structural investment perspective, naturally the IndusInd Bank and the HDFC Bank of the world are still, at a point where if you have a 3-5 year horizon, they give good kind of investment thesis can be on those stocks. PSU largely, our view is basically, the noise around the NPA is almost hitting the climax now.
Right.
So what our assumption for banking basket, particularly if I look at the PSU, for NPA purposes, for next 2-3 quarters, we assume some kind of, climax happening for the NPA, and the trajectory thereafter will be much better. So like if the banks had a provisioning, run rate of every quarter about 40,000 crores or the PSU combined, we believe somewhere Q3 onward of this financial year, we will have some kind of a sharp tapering in the provisioning. So PNL will start looking much better by the end of when we exit the FY19 quarter.
Right.
Interesting. Let's not make it sound like a financial discussion only. What else, Mr. Kumar? The way the markets are poised right now, if you were to put in money to work, what are the pockets that you are putting money to work in?
Right. So let's talk about the market a little bit to
Sure.
give the background. So we are almost like 20.5 plus time price multiple on the FY19 earning. So if you look at the broad aggregate market or Nifty basis, there is not much of a valuation comfort, I would say. I would prefer market to be oscillating between 10K and 9K, 11K for Nifty for at least another 6-9 months. And that time correction will ensure that the multiple thereafter will appear more attractive for investment purpose. So that I'm the camp which is believing, so there should be a range-bound time-wise correction in the market. Still, as an investor, there is never a safe time to invest, right? If you're an equity investor, there is no safe time. So vis-a-vis, the kind of risk you are taking in the market, particularly in the mid-cap space, because I think a lot of high valuation froth is there. So one has to be very cautious as far as the broader mid-cap and small-cap basket is concerned. Stick to those ideas where the management pedigree you have a comfort with right now. Valuation is not too stretched and the return ratio is improving. Maybe FY19, FY20, you believe that these companies that you are investing into, the ROE, the ROC, the free cash flow will be better than what it is in FY18.
So Equitas is one of them, I presume, and you've already spoken about it briefly, just the name.
Sure.
So why that? And if there is something else aside of Equitas that you like,
fine.
then
So let's start with the Equitas first.
Sure.
Equitas has a lot of levers right now. Fine. So start with the cost side. Right. So they have a 45% right now in the overall borrowing basket, the liability franchise. 45% is deposit. It was zero, say 2 years back when they were purely a microfinance company. So after becoming a bank, now their deposit is 45%. CASA is significantly in the part of that deposit. FY19 will be about close to 70%. So overall, the kind of the cost on the fund that the Equitas is using will remain fairly constant. And in a rising interest environment, you want to buy a bank or a particular entity where the cost of fund you don't see going up because of the competition changing, right? On the yield side also, because they were consciously bringing down the microfinance portfolio. So they brought it from 3,600 crore to say around close 2,300 crores last quarter. And large part of the money of the Equitas is into investments, which is yielding just 60 bips more than the cost of funding. If you look at this quarter results, non-microfinance portfolio of Equitas has grown by 50% plus, right? As this growth kicks in continuously, those investments which are right now lying in a zero, like less yielding instruments, will be getting converted into higher yielding advances, right? In terms of asset side as well, now the portfolio is about 28% microfinance. They had targeted 30% by 18, making the microfinance getting overall in the bank loan portfolio. They've already achieved 28%. And then you have a used vehicle finance and the macro lab, etc. So both the asset and liability side make sure that the net interest margin for Equitas, which fell from 15 to almost like current level, from now on there is no decline per se as far as the net interest margin goes. And the advances are growing in a manner which will make sure that net interest income starts growing phenomenally well for the next 2 to 3 years. If you look at the cost side, they front-ended most of their operating expenses. Yes. So like almost 410 branches they had to open, they have already opened 390 something plus. So from here on, the cost-income ratio also will start, becoming favorable for
75 odd. It'll come down.
So yeah, 50 to 80 it had gone. Now it has come down a little bit, and it will fall down to 60, 65. I think over 3 years time period. Net, what will happen for Equitas? The return on asset will become 2% plus, maybe by FY20, and the ROE 16% plus, hopefully. So it's a bank where the management has shown what they are saying. They are actually executing well in time. Valuation is not that demanding, and the financials are improving on a continuous basis. That would be a good idea to, for a real long-term buy and hold purpose, I would say.
Right. Mr. Kumar, there are a handful of infra companies out there in the roads sector which have the benefit of getting and bagging the majority of the NHAI projects.
Right.
Is that one of the reasons why you like Ashoka Buildcon?
So, see, if I look at Ashoka, say a year back, Ashoka were not getting too many orders. Like they were too choosy in terms of what kind of order book they want to add. But this calendar year, we have seen them winning on 6,000 crore plus of order book. So like right now, book to bill is about 2.5 or 2.6 already. EBITDA margin, has fallen for last 2 years, but now here on management is very confident that EBITDA margin will be 13-14% STD. Valuation is not that high, 15 times FY20 earning. So that's a good case for the valuation and a bit of financial improvement. So ROE will improve in the next 2 years for Asoka. So the combination of the two makes Asoka a attractive buy. But the idea is, because broadly the market doesn't look that gung-ho, like that doesn't look that that kind of a rapid rally you cannot expect. So the idea should be in all these good investment names where the theme and the valuation supports you. You have to basically accumulate on a decline. So that would be the strategy, for these stocks as well.
Right. And of course, from the auto space, you like Subros.
Yeah. So why? What is happening in auto again? Our thesis is very simple. Something which is trouble, which is opposite to the trouble, you go and buy it. Like so, what is happening to many auto component company? So first was the electric vehicle. So a lot of auto component particular players, you saw the PE coming down, the valuation multiple falling. And now, because of the commodity price inflation, you see many, there's a margin compression for many of the auto component companies. But look at Subros. Because Subros is continuously, making localization of their raw material. So largely it was 40% of their raw materials was export. They're not shifting gradually to localization, which gives them a kind of a cushion in a rising raw material, price inflation environment. So they'll be able to not only restrict the margin fall, but rather we believe it will be, improving the margin going forward. Right. Net, we believe almost like a 50% growth for FY20 in terms of profit growth over the next 2 years for Subros. And the ROE also will shift from 16 to something like 24 plus. So that's again in a tough environment, a good stock for next 2 years. Like,
didn't they do something recently? They added a revenue stream of some sorts, Subros.
No, so
6 months ago.
So like for radiator business you might be saying or something like, see there is one theme which is adding to this is like, so for every MHSB like trucks and all, you have to come out with a compulsorily AC or a this thing like.
Yeah,
so that's a very new space for these automobile AC manufacturer like Subros.
Right.
And Subros already is tied up with Ashok Leyland and Tata Motors, so that gives another growth area for the company.
Yeah, I remember the management talking to us and saying that could add to about 15% top line in FY19 and maybe more. This is the interaction that he had with us.
FY19 about 200 crores could be, the case.
Yeah, something like that. He had mentioned about 10-15% when spoken
that could
to us
be
in
fairly
December
the case,
or thereabouts when they came out and did the interaction. Okay, this is wonderful. One last question from my end at least, Mr. Kumar. Anything that you recommend people to get out of? Something that has rallied, done its part, and you don't think there'll be a further rally?
Right, so the many stocks in mid-cap space, I think, which is like the valuation has gone so astray. So anything randomly, you just do a screener. Anything 30p more, make
That's
sure.
a lot of names.
A lot of names. So like.
So you'll get out of all of them?
So see, I'll see the next filter. Like, so if the ROE is less than 15% and the PE is more than 30%, and you don't see any chance of these two, improving in the next 2 years, I think it's not a time to be in those stocks.
Okay.
All right. I'd like to add my final question. In that case,
I think we have the management of Bajaj Finance, Agam.
All right.
Okay. Sorry. My bad. I heard that we have the management.
Yeah. No worries. We'll wait for Bajaj Finance. Of course, we are very keen to speak to the management. But if I just consider the Nifty 50 companies right now, there are some who suggest that the Nifty companies have not corrected as much as some of the mid-cap companies. In that case, where do you think that you'd like to at least partially book your profits right now and then wait for better valuations and then move back in?
But see, Nifty less correcting is, in a month or 2 months, 3 months time frame you're saying. Look at 3 years, where the Nifty has gone up and where the mid-cap has gone up. So still the differential of the valuation premium of the mid-cap is so large, largely higher than the Nifty and the Sensex. So still, idea is to reduce the where the valuations are much higher than.
Okay. Interesting thoughts out there from Narnolia Securities. We usually have him in front of the camera out of the Calcutta office. The first time we have him in the studios, and it's a pleasure to have you, Mr. Kumar. Thank you so much for taking the time out and speaking with us. And viewers, I hope you benefited by some of the ideas and the rationale essentially behind the ideas as well. Each of these ideas that he's presented has some logic as to why is it that people can invest into them. Thank you so much for sharing those with us.